We have another great show here on the Professional Edge. I appreciate you tuning in and listening. What we're going to talk about, there is a lot going on in the economy. The Fed has stated pretty clearly what they are going to do to temper this inflation. And basically, it was a shot across the bow. We've had some pretty aggressive rate increases. So that's why we're titling this show, Can't Fight the Fed. So when we look at that, first things first, we had a zero rate environment there for a very long time. It gave a lot of economic stimulus and allowed individuals to get 30-year mortgages at below 3% rate. Now, with the Fed increase and the shot across the bow, we have additional rate increases coming. That's what's all projected. And how is that actually going to impact your portfolio and you as a listener here on the Professional Edge? What do you need to do? We have that shot. They have loaded the cannon. They're about ready to light the cannon and fire that shot. So you as a listener here on the Professional Edge, several things you need to put in place, or at least understand what's going on. We have went from a 30% drop in the NASDAQ from the beginning of the year. Basically, January 3rd was the all-time high. And then we had a correction, and the NASDAQ dropped over 30%. The S&P 500 index dropped over 20%. But we've had this recent increase, or at least rebound, as they say. And in the markets, they say, is that a dead cat bounce? And we don't know yet, but there are several warning signs which you need to heed. And that's why we offer our listeners here on the Professional Edge a free consultation to see exactly how this new rising rate environment is going to impact your portfolio. And also, we've discussed on here several different occasions the sequence of return risk. Now, if you retired the end of December of 2021, things were rosy. Man, by January 3rd, after you crested in the new year and cheered and had the champagne, you hit an all-time high on January 3rd. And then all of a sudden, something happened. Things went south. Well, the S&P dropped 20%. The NASDAQ dropped 30%. So you, unfortunately, if you recently retired, are facing what we have talked about on the sequence of return risk. And how does that impact your portfolio? And if you've never sat down with an advisor to see what that impact has, here's the wake-up call. Give our office a call at 877-654-9798. That number again, 877-654-9798. So we can meet down at the Cunningham Center with the advent of Zoom. We also do that as well. So again, take advantage of that. And the other thing you need to take advantage of that we've mentioned is emcthebundle.com. That is Echo Mary Charlie thebundle.com. It's an offer to you to beat that inflation, the rising price environment. We've actually slashed our prices on that to incentivize our listeners here on the Professional Edge to get things started, because we are entering very quickly into the last quarter of 2022, which is amazing to me. Summer's over. We're listening to this on the Labor Day weekend, and it is pretty astounding what has transformed or what has transpired. We have this very low unemployment rate, less than 4% unemployment, which means we are gainfully employed. There are job postings everywhere. If you want to get your CDL license and drive across the lower 48, Walmart is paying north of $100,000 for some of their positions to drive on the open road. And that's going to be placed in the prices in which we pay. So when you go to Walmart, even though they are the low cost provider in a lot of sectors, those additional costs to incentivize individuals to come work for them, they've had to pay higher wages. And well, that's inflation. So therefore, those higher wages have to get reflected in the price of the products in which we pay. So you as an investor Where do you position yourself in this rising rate environment? And the Fed, like I said, just met this past week at the economic conference, and they explicitly, Fed Chair Powell said very clear that more pain is coming. He is going to tame inflation. So with this more pain coming, what are you actually going to do? Where can you hide? Well, we all thought bonds were a great place, and they were when interest rates remained low or were decreasing, because remember, bond values are inversely related to interest rates. So as interest rates rise, the value of your bond portfolio has to fall by definition. And sure enough, it has. And that, when the economy slows down, and that's another topic for discussion, is the economy actually slowing down? It's hard to say because we've had this summer travel, which everyone had pent-up demand because of COVID. So everyone went on vacation this year, and that increased the price of airline. Again, if you have increased demand, you're going to have the ability to increase prices, and that's what the airlines have done. They knew people were going to travel, and they were going to take advantage of it. And then hotel rooms were doing the same thing. There was an increased demand. So if there's such a great demand, then we can actually charge higher prices. So it all comes into account when we look at things going forward. So as the economy remains strong, yes, I believe it is very strong, then where do we position ourselves if the Fed is saying that they're going to continue to raise interest rates? And in school and in graduate school, the one economics professor said you can't fight the Fed. And sure enough, if you were going to say the economy is slowing down and we're going to move our portfolio over to bonds, well, that was probably not the right move. There was other moves that you should have done that are dividend paying areas, such as preferred stocks. That's one sector that is resilient. And as interest rates rise inside that preferred stock sector, a lot of those companies that are in there are actually banks. And in a raising rate environment, bank stocks historically have done very well. So that's something you might want to jot down and say, okay, I moved over to bonds and I thought that was a safe haven. But yes, it was a safe haven if there's a decreasing rate environment or a steady rate environment, meaning the Fed's not telling you that they are going to continue to aggressively raise interest rates. So if you move to bonds, that was the wrong way to go. But if you want a second opinion, do give our office a call at 877-654-9798. That number again, 877-654-9798. So now you may have moved to bonds. Well, is it too late to get out? Not necessarily, because some of those bonds actually have lost in value, and that's okay. And being a tax attorney and a CFP and a certified financial, that CFP stands for Certified Financial Planner, and a CPA, Certified Public Accountant, then you might want to go ahead and capture that loss. And you say, wait a minute, I don't want to sell. I don't want to be out of the market. Well, it's okay to sell that as long as we reposition you back into a different equity investment. And that way we capture that tax loss, because we know there's going to be some capital gains distributions that come through on your brokerage account, your 1099. And understanding how these components fit together, that's a unique combination that we have for our clients at Estate Management Counselors. So we go ahead and sell that, capture it, we realize, and we are going to recognize that capital loss. And it's okay, because we can take that capital loss against our other income subject to limitations proposed by the Internal Revenue Service, which is fine. But if we have that loss that we cannot utilize on our 2022 tax return, we get to carry that forward indefinitely. So that's something, being a unique combination, again, a registered investment advisor with a CPA, Those two things work hand in hand. So again, if this is not the level of counsel and advice that you're getting, maybe it's time to make a shift. And again, we're not going to fight the Fed. We're going to work in conjunction with the Fed and what they are telegraphing. So you, as a listener here on the Professional Edge, need to take advantage of that. And the number to call is 877-654-9798. That number again, 877-654-9798. So where do we need to go if we have a rising rate environment? Well, we want to definitely make sure that we get our credit cards paid off because the next time you see your statement, they're going to make an adjustment or they're going to send you out a new, quote, revised contract agreement. Here's the terms and conditions going forward. If you miss that payment, then that low introductory rate, that 5% maybe in our example, would go to 19.97%. So be careful in making your credit card payments. And yes, some listeners here say, well, I pay my credit cards off all the time at the end of the month. But yeah, we might get busy, might be out of the country on one of our travels. And lo and behold, we miss that. And guess what? The credit card company has the legal right to change your applicable federal rate to whatever they state in that contract or agreement. And it could jump to 19%. We've seen some as high as 27.9%. That's almost 30% for borrowed money on your credit card. And yes, it is borrowed money. So make sure that you pay those on time. That is, again, don't fight the Fed. You can't fight the Fed. So be sure that you pay your credit cards off, and we're going to have more coming up here on the Professional Edge. My name's Sean Todd, tax attorney, CPA, and certified financial planner. And if you can't reach this show, then we have our podcast. Again, that is on Google, that is on Apple. And you can do that by just searching for Professional Edge. You'll see my picture there or my mugshot, whichever one you want to say. And pass that along if this could be helpful. More coming up here on the Professional Edge.